Welcome back to The Hurdle Rate, episode 40 for the week of December 15th, 2025. I'm Tim Kotzman. We don't have Ben Workman, but I'm joined by Matt Cole and Jeff Walton. And this week, the story is simple. Bitcoin continues to set the benchmark while the legacy system scrambles to keep up. We were talking right before we started about the NASDAQ filing for 23-hour during weekdays trading. So that was an interesting headline. I'm sure Jeff probably has some thoughts on Strategy, which just executed another $1 billion purchase, over 10,000 Bitcoin off the market. It brings their total holdings to more than 671,000 Bitcoin, acquired for over $50 billion. That's a nice round number. At the same time, last week, we saw the Federal Reserve delivering the widely expected 25 basis point cut. The policymakers openly admitted that the data was messy, with debates over shelter lag and so-called phantom inflation. Obviously, you contrast that with Bitcoin's monetary policy. It just happens to be fixed, transparent, and immune to revisions. So just totally different systems. The Fed's cost of money is drifting lower, even as Strive just raised the dividend on SATA to 12.25%. And you see ETF issuers like Bitwise and Fidelity continuing to build products around Bitcoin's return profile. So speaking of strategy, obviously we've seen no public company in the history of the world engineer a balance sheet the way that they have. And so when we talk about Bitcoin as the hurdle rate, regardless of who said it first, this is exactly what it looks like in real time, right? Corporations using capital markets and cash flow to migrate their treasury assets into a monetary network that compounds. So, Jeff, I'll throw it over to you. Any other thoughts on strategy or other topics you want to dive into?
Yeah. Really, there's so much going on in this entire marketplace. And, while the price of Bitcoin is down recently, it doesn't mean that the Bitcoin network and the people that are running and working in the Bitcoin network are stopping behind the scenes. On top of this, you've got the MSCI topic and the conversations that are happening on that front. You've got Saylor and Matt Hogan in with JP Morgan this last week. We had Bitcoin Meno the week prior to that. So we were talking with folks all across the globe. There's just so many things happening right now. You've got the Clarity Act, you've got Bitcoin for America Act, and things that are hitting politics in different ways. And everybody's working on many things, yet some people are still incredibly bearish about, 4-year cycles. While when you take a step back and you look at the macro environment, the monetary ecosystem, the plumbing of the infrastructure of the market, and how everything is shaped for the future in 2026 and beyond, there's a lot of positivity within the marketplace, just structurally, politically, and corporately as well. So even just looking at strategy, right? Just over the last 2 weeks now, they've purchased 21,000 Bitcoin. This is the biggest 2-week stretch of capital raising that Strategy's had in 2025, sans if you pull out the perpetual preferred equity. So a lot of, I guess, strength in the volume with Strategy being able to purchase Bitcoin at a depressed value here. And I was just running some math prior to this, and it's pretty fascinating. Strategy started the year with 447,000 Bitcoin, and currently, December 15th, they're at 671,000 Bitcoin. So they purchased 223,000 in 2025. That equates to about 641 Bitcoin per day, if you were to break it down on a per day acquisition basis. The Bitcoin miners are mining roughly 450 Bitcoin per day. So Strategy over 2025 has accumulated 142% of the daily supply. So they are accumulating over and above what the natural sellers, the miners, are putting in terms of new supply into the market every day. So they are accumulating excess selling pressure within the market, and they're showing no signs of slowing down. In fact, almost the opposite. Right? They've developed and created 5 perpetual preferred equities. They've laid the foundation for other companies like ours to come in with a perpetual preferred equity and other companies to grow into this ecosystem. So, right, that strategy, accumulating 641 Bitcoin per day, is just that's just one company. And they've also created the environment for other companies to copy them. And I haven't pulled in, how many Bitcoin the ETFs have purchased or other corporations have purchased. But if you take those into consideration, that number balloons drastically. And we're not taking our foot off the gas, and neither is anybody else. So yeah, I'm curious, Matt, to get your thoughts on where we're at here in this ecosystem. There's just there's buzz everywhere, yet the price is down.
I think this gets into the classic differential of short-term markets versus long-term fundamentals. And you see these scenarios pop up all the time in markets. I mean, what popped to my mind was when we went public and we posted a long form X post about the fundamentals of Strive being very strong and the short-term technicals that, we thought they might be pretty weak. And we put that out there at the time. And I think for Bitcoin right now, you're seeing a similar scenario. And it reminds me of many past Bitcoin sell-offs and breakdowns where you look at the fundamentals, you look at all the Bitcoin treasury companies buying, the fact that the ETFs are still just becoming available to large pools of capital every week. I mean, what are we 2 weeks out from Vanguard clients being able to buy Bitcoin? You obviously see Saylor at JP Morgan. You see the not QE just fire up last week, and it's hard not to be almost max bullish on what the next 5 years is going to look like. And the reality is that what the next 1 year looks like, none of us know. I mean, I would say that the backdrop feels pretty strong, where it feels like we've disconnected from price versus fundamentals right now. But sometimes this is why you have to be very careful when you use amplification of leverage to not get over your skis and not be able to ride out short-term dips, because the reality is we don't know what the next 6 months, 9 months, 12 months would look like. But I can tell you that if you've done a Bitcoin treasury play well, and I think that we've done it well, I think Strategy's done it well, that we can ride these things out, right? And we can let time be our friend. And when you can let time be your friend, that's how you can sleep comfortably at night and kind of feel like you're holding the nuts, right? That you're holding, in the poker analogy, pocket aces. And I think that's where we are right here. I mean, today was a rough day for markets, right? I mean, it's been a rough several weeks. I mean, Bitcoin's down, 2.5%. Most Bitcoin treasury companies are down somewhere between 5 to 15% today. Miners are getting crushed. And I think what you're seeing is something that we've talked about before, where I don't even think we really saw a true bull market yet. And I don't think we've seen a true bull market really in Bitcoin since 2021. And I go back to that Bitcoin gold chart where Bitcoin has not broken out versus gold since 2021. If you look at the chart, it's sitting right about its 200-week moving average, just below it, which, if you look historically, that's basically marked around the bottom of every single bear market sell-off in Bitcoin, when it's right at or below the 200-week moving average in versus gold. And so could we be at a similar place right now? I think with sentiment, it feels like we are probably closer to a bottom than a place where the bottom could fall out. But are we at the bottom? Could we go lower? Could we go to 65, 70K on Bitcoin? Sure, absolutely. My view is just that it doesn't really matter. It's when you have these conversations and you see these flows, that it's gonna go up regardless. The question is it in 3 months, 6 months, 12 months, or 24 months? And if that's kind of the perspective, then you just really make sure you're staying on top of the fundamentals, and you make sure nothing's changed. And I don't think anything's changed, other than I think it seemed like when Trump got reelected, and last year, a year ago, we were hitting 100K, that it could have just mooned up, and the reality is that it could have. And I think no one's going to be great about predicting when the market's just going to rip your face off to the upside. Like, that's not going to be the game that we're great at. The game that we're going to be great at is understanding and positioning, and not just looking at the short-term charts, but taking long-term fundamental positions. And I think that's where we are, and that's why these podcasts and us talking about these things are so important, because I think it is important to say, has anything fundamentally changed? And I think the only thing that's changing fundamentally is actually more bullish long-term signals. So I feel like we just got to wait.
I would love both of your reactions to Fidelity. Fidelity just came out today and said Bitcoin could be entering a, quote, decade-long super cycle. And I know we've talked about this on the hurdle rate previously of, with volatility, obviously, we may just be, right, if you're going to sell and try and buy back in, right, you might be left behind sort of conversation and narrative or reality, right? If you see the same thing with Bitcoin that you saw with gold when you first had the gold ETFs come out. Any thoughts on that, Matt?
So I am in the cycle of a super cycle, and just to give you a sense, so like I was talking about when I was saying that we haven't even started a bull market really yet. We haven't broken out versus gold, and maybe there's some downside to Bitcoin. Maybe it goes. I mean, not my prediction, but is it possible it goes down to 65K? Sure, but if you think about that. That's about a 50% decrease from the high, actually just under a 50% decrease. And super cycles of a volatile asset like Bitcoin, typically what most people mean when they say that is that they're talking about a decrease in the downward volatility with sustained upside. And so historically, Bitcoin in bear markets have gone down 80%, 85%. And if you look at what that would look like from what Bitcoin's all-time high is, it would be substantially lower than 65K, right? If the all-time high is 125K, you're looking at a price of 30K, something like that. If it was similar, if that was the top and were similar to other downside markets, and I think that is nearly impossible for me to say that I would think that Bitcoin would go down to $30,000 again. So if 60,000, 65,000 is like a reasonable bottom of a bear market, which again, I don't even predict that it would go there, but let's say it did. That's more of like a super cycle, actually, like a 50% drawdown from a high, and then we move higher. And that, if that persists for a period of 10 years, I do think would be a super cycle, but it almost could feel maybe a little bit more boring at times. And I think that's what we're seeing right now, is that we're used to Bitcoin going up to 300K by now and then falling down to $80,000 or something like that from there. And I think the volatility is decreasing, but the upside is still there. So I do think we're in somewhere between a 10 to 20 year super cycle, and we'll have to see how things evolve and how long it could go.
Yeah, the fundamentals are incredibly strong. And just taking a step back and you look at the entire landscape and how things have evolved. And if Bitcoin has a positive year in 2026, all of the 4-year cycle theory people are wrong at that point. And then they have to reevaluate their perspective and their point of view. And that can change how, a large cohort of people are understanding and seeing the Bitcoin world. I think one thing that I've been thinking a bit about as well here is portfolio construction and how people think about volatility. And I think what's typical, or at least what you see on X and social media platforms, with how people talk about assets like Bitcoin or highly volatile stocks like MSTR, when the stocks go down or they're volatile to the downside, they're some of the first things to sell. When in reality, they should be the deepest in your portfolio. Like, you could think of a cave, and like you want the most volatile things as far as deep as possible away from the sell button, and you want the protection of other things, whether it be more liquid, less volatile things near the front. So if you did experience a period of volatility where you needed liquidity, you would be using the liquid instruments and protecting the volatile instruments. And just thinking about how, like, the construction of an insurance companies are purposefully designed this way. 80% of the portfolio of an insurance company is bonds, 20% are equities, and then they have cash positions as well, and they've got premiums that are coming in the door, and they purchase reinsurance to protect against catastrophic situations, so they don't have to liquidate their illiquid assets or liquidate assets when you may not want to liquidate them, like equities being down or bonds being down, et cetera. So that design is what a lot of retail people may not contemplate or consider, is that these highly volatile assets with really good fundamentals and long-term prospects are actually the ones you want the deepest in your portfolio, and you want them the furthest away from the sell button as possible. And that's how successful financial corporations treat highly volatile assets as their form of capital, right? Moving forward. So, and this is also brings up the topic about what Saylor had talked about at Bitcoin Mena, with this concept of digital money, which I think is a fascinating topic, and maybe we could get into this a little bit more. But the concept of a company or some entity creating a digital money vehicle that is constructed of 80% perpetual preferred equity, like Stretch or Seda or something like that, and then 20% money market funds, and then 10% cash. So that adding up to 110%, just creating a vehicle that has a volatility effectively of zero. So you can remove some of the volatility from the existing perpetual preferred instruments and start to construct and use that vehicle in different ways within the traditional financial ecosystem. And part of this concept is like, how do you interface with traditional finance? How do you interface Bitcoin with traditional finance? And to me, if you're looking to interface with TradFi, the perpetual preferred equity from Strategy is a better form of collateral to interface with the traditional financial ecosystem than Bitcoin. Because what's better than Bitcoin? It's over-capitalized, less volatile Bitcoin when you're interfacing with large capital that requires low volatility for specific periods of time. So there's a lot of opportunity. I mean, Michael Saylor launched a $1 trillion idea on stage and said, this is there for somebody to take it. We're not going to do it, but this exists. And I'm curious to see who grabs the reins there.
Yeah, and when you were talking about that analogy, I also started thinking about the cash reserves at Strategy and Strive have both talked about, and that in a different way also being a buffer, right? That how do you underwrite volatility in Bitcoin, amplify it, but also be mindful of short-term markets and to be able to ride them out, right? And the concept of a 1 to 2 year cash reserve with amplification allows you to have a buffer before and multiple buffers, right? Because it's not the only buffer, but it's the first layer of buffer to protect your Bitcoin, right? And obviously, the Bitcoin's obviously there and can provide, 40 to 80 years of interest coverage depending on your company, if you're Strive or Strategy. But it really does allow you to take a longer term view here, and I think that that's something that's missing, and I think a learning for the market as a whole, right? In this week, we did see another Bitcoin treasury company have to sell nearly half their Bitcoin, right, by taking a short-term loan. Now, the company didn't blow up; they're still in business, right? But they had a loan that was due, less than 1 year before they first bought their Bitcoin, and so that type of amplification, it's much more similar to what an everyday retail investor would take when they take amplification, and usually that ends badly. You have to be very precise on timing, and I think that's a difficult game to have to play versus protecting whether you're starting to fund and you're buying perpetual preferreds, but also having money markets to have some better liquidity in downward markets, or you're running a Bitcoin treasury company and have cash reserves and amplification, that you can structure a way to ride out volatility. And I think that that's a requirement these days.
Do you guys have any thoughts on the OCC issuing conditional national trust bank charters to BitGo, Fidelity Digital Assets, Paxos, and a few others? I mean, certainly it expands the federally regulated backbone for custody and settlement. What does that mean, do you think, in reality for every Bitcoin treasury company? And, zoom out to the corporate and the institutional landscape.
First of all, it allows the companies to not have to deal with individual state regulators and get regulatory approval from each individual state. So it provides some national approval to operate within all state jurisdictions. So it provides more flexibility for the company to operate. And then they're now like BitGo, for example, being a qualified custodian. I'm not 100% sure how that will, I guess, permeate or change things, but I suspect it provides more capacity for lending opportunities or regulated infrastructure, like nationally regulated infrastructure for these custodians. Matt, you might have more insight on that.
It's really just the start and the continuation of the maturation of the industry, right? I mean, you saw even the name that was not named, Ripple, is also a bank right now, which is interesting. But I think what we're seeing is that you have a merging of the crypto and Bitcoin ecosystem and the traditional banking ecosystem, right? You had, on the same week that happened, you also had Saylor and Matt Hogan in JP Morgan's office, right? That these industries are connecting, and it even gets into some of the arguments that have been made with MSCI and this index inclusion, is that Bitcoin treasury companies are great innovation, but they are operating companies, right? Balance sheet companies are operating companies, and how the balance sheet will be utilized over time will evolve. Right now, you're seeing the early days of digital credit being brought out into the market, and the great product that is out into the market, but how a balance sheet is used to ultimately benefit shareholders is going to continually evolve, and ultimately it comes down to the debate of the day is, that the Bitcoin hurdle rate is, if your company sets Bitcoin as the hurdle rate, and who cares who came up with that first, although I'm gonna say I think it was me, but we'll let the audience find people that started saying that publicly before January of this year. But it doesn't really matter who came up with it. The question is really, are you as a company setting Bitcoin as your hurdle rate? And if you are, then the next question is, are you able to compete on a level playing field with other traditional businesses, right? Because if you start to see things like Bitcoin and crypto companies not able to compete directly with banks, not able to get the charters, well, that is going to raise their cost of capital. OCC just struck that down and is allowing that direct competition. If index funds kick out Bitcoin treasury companies, well, that's going to raise the cost of capital to a Bitcoin treasury company. It's going to harm the shareholder returns for index holders. Funny enough, who will benefit will be the holders that are actually, retail holders that are owning Bitcoin treasury companies in their own account, because they have less competition. But ultimately, we should want this to go through. It's going to help everybody to grow the pie. But my point is that for these new companies, you want to see these walls broken down. And I think the fact that the OCC allowed this is great, and it allows the innovation to continue to seep into the market. But whether it's going to be a big change for us working with a company like Bitcoin, I don't think so at this point.
Just more positive news.
Yeah, it's positive news. It's breaking down doors, and it's like a lot of the crabby markets, bear markets, a lot of work gets done every single time in Bitcoin's history, and I think that we're continuing to see that on all these different fronts, and it's why when these markets are like this, you got to keep your heads down. You got to keep building these things, because then when the bull market comes, you've really built out a great ecosystem, and so we're going to fight the index fight. Some of these companies are starting banks, and I think it's all great.
And it makes these companies more systemically important too. whether political regimes change, is if there's infrastructure built out and these companies are operating as chartered banks in all of these states and they're offering services, they become a lot more difficult to shut down if somebody doesn't like that rule. So I think it's good news for the health of the overall ecosystem.
I mean, it wasn't too long ago that a lot of Bitcoin companies would basically operate in every state but New York. And I'm guessing that this OCC charter is really helpful to break down some of those barriers to do business in New York. So good news for you, Tim.
Yeah, finally, right? As fiat systems falter, wealth preservation isn't a strategy, it's survival. While the world reacts, Swan Private clients are already prepared. Swan Private builds strong relationships with clients around mutual conviction in Bitcoin's long-term promise. With concierge service, deep expertise, and airtight security, the Swan Private team helps build generational wealth the right way. Swan Private's comprehensive Bitcoin wealth platform serves over 5,000 clients with more than $4.5 billion of Bitcoin purchased to cold storage. Swan Private is built for long-term partnerships. Get started today at swan.com/private.
So I've got one topic that I want to talk about, which is valuations, which is something I've been pulling on a thread a bit more recently. And one thing that I've been finding fascinating, just been comparing market cap valuations of Bitcoin treasury companies, not just strategy, all of them, relative to their peers from a market cap basis at different market cap sizes. So some of the smaller Bitcoin treasury companies, thinking like I mean, even our companies that are trading around it, like Krispy Kreme, for example. A lot of these companies, if you look at their balance sheets, the balance sheets are constructed. You look at the asset side of the balance sheet, and several of the companies around that size have huge goodwill figures as an asset sitting on their balance sheet, which goodwill is effectively, if you acquire a company and you pay more for that company than the net asset value of that company, that delta is reflected as goodwill on your balance sheet as an asset. So that could be like brand, or it could be, a call list or an email distribution list, or, any of these different things. And they're recorded on the balance sheet side as an asset. And that number is really just a number out of thin air, and is a function of the existing marketplace in the equity market. And that is it's fascinating because it's not liquid, right? It's completely intangible. And that number, like if the company went out of business, that number could actually be zero, because that intangible asset may not actually be worth something. Like maybe nobody wants to buy that intangible asset in the future. So it's illiquid, one. And then two, you look at the other things on the asset side of the balance sheet, and there's accounts receivable are generally a very large portion of assets for some of these smaller publicly traded companies. And those accounts receivables are taking on credit risk. And the accounts receivable have credit risk, and that credit risk is calculated, every quarter. You're supposed to draw down or make an impairment charge for what the credit of that account receivables is on the balance sheet and take a haircut. But there's some flexibility in that number. So a lot of these companies are they're holding intangible assets with goodwill, and they have credit risk in the asset side of the balance sheet. And when you start to maybe pull out some of the goodwill, or take a little bit of a larger haircut on some of the accounts receivable, some of these smaller companies are trading at egregious price to book ratios, very low, very small balance sheet assets, very little liquid cash. They've got perhaps negative net income. And you start to look at these balance sheet companies that have very strong balance sheets relative to this story of these companies that are burning cash, no balance sheet. Most of the assets are goodwill. Most of the assets are accounts receivable. And these businesses look incredibly healthy. The Bitcoin treasury business is looking incredibly healthy relative to these other things, despite the price of Bitcoin being down. And it's just a fascinating dynamic that there's, I think, significant credit risk in some of these, and the market isn't necessarily aware of the fact, at least the retail market isn't necessarily aware of the fact of all of these peers that are trading around these companies and the flexibility that they may or may not have. Whereas if you have the capital, you have the flexibility to do things, whether that be take on leverage or buy things or acquire companies or, XYZ. So
It really is fascinating. I think it comes down to the bewilderment of a balance sheet company. And it's not that balance sheet companies haven't existed, but you see this. I mean, we've talked to public company CFOs this year, S&P 500 ones, and you tell them, maybe you should consider not just doing share buybacks or dividends when with your profits. Maybe you should consider the fact that AI is a substantial opportunity, but also a substantial risk to your business, and maybe you should consider holding on to some of that cash. And and then it's like, how's your company thought about if your company's on the losing end of the AI battle, and you go down some of these companies list, and I can't believe you just compared us to Krispy Kreme, but great,
Krispy Kreme is
great.
larger than
But you see some of these companies, and some of these are just like absolute sitting ducks to be completely disrupted, and and then the question is, well, what makes up the value of that brand goodwill? And how much is that brand actually worth? And it it's funny enough, actually, there is a market on failed brands of like bankrupt companies. This was something that you get pitched. We've talked about, we got to say no to about 99% of things that get thrown our way. But one of the things that got thrown our way back in the day, so maybe if someone likes this, here's an idea for you, would be to basically acquire one of these companies that completely failed. So a Lehman Brothers or something like that, buy the brand asset for this company. And the going rate for these tend to be around 5 million bucks. And so that's probably your floor goodwill valuation for Krispy Kreme. It's probably like $5 million. I don't know if what the actual goodwill is, but I'm guessing it's substantially higher currently, right? And it doesn't have a hard asset, so you really have to hope that your company keeps having the same brand value in the market, because if it collapses, there's nothing but beneath it, where a balance sheet company has a lot beneath it. And I think that people still don't understand the risk and the opportunity that presents.
Yeah, yeah, absolutely. And then the other side, the accounts receivable side, what if the accounts receivable are from another company that's subject to AI disruption? And that's just not good money. It's just gone. And what's the credit risk calculation, and how is that being calculated and massaged into financials? And again, I've looked at several of these companies, and when you start to compare MNAVs and you look at price to book multiples, if you pull out some of the goodwill and you pull out some of the accounts receivable, the MNAVs of these tiny, small market cap companies quadruple, quintuple, 10x, and their relative valuations look incredibly high when they're burning money. They have no balance sheet, and the accounting side of the equation is a little sketchy. So it's fascinating, and I continue to be surprised at the relative valuations of these companies, and even Strategy being like the 220th, 215th largest company in the U.S. market, yet they have more Bitcoin than anybody else by like 12 or 13x, and they're continuing to run away with that number. and Bitcoin's their hurdle rate, and they're just plowing forward. So yeah, it's blown me away.
Reminds me of a conversation I had at Mena on quantum risk. And so I was talking to someone that's pretty well known in the space, and they're just talking about quantum risk, and if they thought that if quantum actually became a true risk to Bitcoin, so let's say that we actually updated to a soft fork to a new protocol, people migrated their wallets to quantum resistant wallets, but wallets like most namely Satoshi's million coins became basically up for grabs. Like what would likely happen and would it kill Bitcoin? And we started going through this thought exercise, and it's like, well, how many companies would likely be able to actually hack the coins? And it's like, okay, probably Google, Microsoft, name your other companies. So call it like, 3 to 4 companies in the world, right? It's not like going to be some, random Yahoos in North Korea that are going to be the ones that are going to crack Satoshi's wallet, right? It's going to be someone that we're familiar with, right?
Tons of energy, tons of money, tons of compute. You
So
need all.
so yeah, so let's say that they get it, that they get it, right? It's like basically Ready Player One, if you've seen the movie, right? Where there's this race in the digital world to get this massive honeypot, and they get it. Okay, well, let's say they get it. Are the coins actually theirs? Good question. I guess we'll see it in the Supreme Court, right? It's going to be challenged legally for several years. If they did get it, so let's say one of them got a million coin honeypot. Okay, several years down the road, that probably means basically you have two companies with a million coins, Strategy and Google, or Strategy and Microsoft. Is that going to break Bitcoin? No. So it's actually probably the only way that you could actually have a large company catch up to Strategy, right? Would be if in this quantum scenario, but does it actually kill Bitcoin? Absolutely not, right? And you just start thinking about this and realize how anti-fragile the Bitcoin ecosystem is. It's incredibly difficult to break. And when we kind of went through that thought exercise, because initially they were bringing it to me that they thought it would kill Bitcoin, and then I walked through. I said, "Do you think that scenario would kill Bitcoin?" Like, no.
Yeah,
It
right.
probably make the price go down for a little bit. People would be freaked out, but does it actually kill the network?
Yeah. Yeah, and perhaps there's some offloading of coins to recoup the cost of the energy associated with finding those wallets, perhaps. But
Perhaps, but perhaps not. I mean, how these large companies, how often do they invest billions to hundreds of billions of dollars for the next wave of innovation? Um, I don't see why they would have to.
right.
They actually would become a fiduciary over a balance sheet, right? Where like they have to think about how to maximize value to their shareholders with this large asset that they would have if it was deemed to be legally theirs, which I think is an interesting legal theory in and of itself. And my guess is a company like Google would be very slow to offload coins until they actually knew that they were legally theirs.
Wow, that's an interesting thought concept. And then what does the world look like if that is feasible too? Right? Like what's the existing banking system look like? Because the banking system is far more susceptible to high compute risk than the Bitcoin network.
Yeah, I mean, it's an interesting thought exercise, and probably what most people I think is the biggest risk to Bitcoin. But if you can actually get comfortable that it'll likely work out okay, then I'll take that risk over the risk of inflated goodwills all day, every day.
Yeah, it's like actually having a balance sheet capital over inflated assets on a balance sheet. Yeah, I agree. That's a good thought exercise, Matt. Yeah, I think that it's a really good point in that the company that would be it would likely be a company that's going to succeed in a quantum scenario like this. It's a company that's deploying significant amount of capital and they're focused on it. If it happens, it's pretty far down the road, at least like 8, could be 12 years. Yeah. Hmm. Yeah, it's likely not some nerd in his basement cranking up, you know, gigawatts of compute power. Huh.
Maybe one last quick topic. It looked like a news item, but maybe you guys will have a different take. Maybe it's a nothing burger. As of this morning, MSTR is staying in the NASDAQ 100. Is that a non-news item?
Well, as of the date where they got recorded, I think they were 85th or something in the top 100 U.S. or sorry global non-financial companies to be included in QQQ. So there would be no reason for them to fall out, and the Nasdaq 100 is far less subjective. It's very prescriptive. If it hits these criteria, then they're in the index, very similar to, I guess, the Bloomberg version of the S&P 500. And as of the end of the ranking period, they were within top 100. So they should stay in. There was some concern, I think, theoretically, that because of this MSCI stance to exclude companies that hold greater than 50% of their assets in Bitcoin or digital assets, there was some speculation that NASDAQ would follow suit. But there are two separate indices. MSCI is separate from NASDAQ 100, different companies, different infrastructure, different rules. And I'm not terribly surprised, but there was a little bit of a concern in the market.
Yeah, I think it's non-news, but I think it's important at times like this because it helps reinforce the education that there are several different indexes here, and different indexes have different rules. You have the S&P with its black box committee, right? That you are basically on the outside waiting to get in, and theoretically strategy could get in, but we know that black box is really hard to push through. And then you have MSCI talking about index exclusions. You have NASDAQ that's rules based and strategies staying in. You have Bloomberg indexes. Bloomberg is obviously a major financial organization, and strategies in the Bloomberg 500, and they've been in the Bloomberg 500. And so, just one company is not gonna tell the story for the whole market. And as much as the MSCI matters, even if they're kicked out, there's a million other indexes that strategy and other Bitcoin treasury companies will stay in.
And I think when strategy was included, they were around 50th, ranked around 50th largest global non-financial NASDAQ company, and now being ranked at 85th. So the relative proportion of assets or capital that will go to strategy will be less than it was when they were initially included in November of last year. And I would assume that's likely being priced into some regard, but moving forward, like as the positioning or rank within that index changes, there's different capital allocations associated with it. And it's not linear. Because these are market cap weighted indices, NASDAQ 100 is market cap weighted. So as the company climbs an index rank, it's not a linear amount of dollars that's going into each one of these companies. That's actually a bit of an exponential curve. For example, I think Mag 7 is responsible for something that's probably like 40 or 50% of the NASDAQ 100 capital allocation.
Any final thoughts before we wrap it up?
Yeah, I mean, for me, the fundamentals of what's going on in this ecosystem haven't been better. The road is pretty clear. It's getting clearer every day. We've got the Clarity Act in Senate that's being reviewed. We've got the Bitcoin for America Act, people potentially being able to pay their taxes in Bitcoin. You've got strategy is buying more Bitcoin than the daily new supply that's hitting the market from the miners that are potentially selling. You've got companies that are issuing digital credit. People are building business infrastructure around digital credit and Bitcoin. You've got the number of companies buying Bitcoin is increasing over time. I think and you've got the Fed is now dovish, ending QT, going into QE, interest rates coming down, digital credit looks really attractive in a lower interest rate environment. Like all of these things are very positive, just taking a step back and looking at the space. So there's a lot to be excited about, despite valuations being incredibly depressed and the price of Bitcoin being down, 30-ish% from all-time highs.
Yep. Never been more optimistic about the future, and just gotta keep strong.
Bear markets for building.
Yep.
I've just got one word: supercycle. I think the next decade or 21 years, as Matt mentioned, is 10, 20, 21 years. Pick your number. It's going to be super excited, and I'm super excited to be here building with all of you guys as a community. So thanks for everybody for listening and watching. For Jeff Walton, Matt Cole, I'm Tim Kotzman. This has been episode 40, and we'll see you next week.